welcome to Commodity Champions. The government has released guidelines for the fifth phase of unlock with more relaxations. Maharashtra now becomes the latest state to allow hotels, food courts and restaurants to allow dine-in from the 5th of October with 50% capacity. Some other states are also likely to follow suit and allow outdoor dining with limited capacity. So will the demand for food commodities see a surge in the coming days? Joining me now to take that discussion forward is Avinash Verma, Director General, India Sugar Mills Association. Also on the show are Ajay Goel, Director, Shivaji Flour Mills Private Limited, and Angshu Malik is CEO of Adani Wilmar. Gentlemen, thank you so much for joining us on the show. And Mr. Malik, I want to start with you. The unlocking has been progressing on a month-on-month basis. What really has been keeping the industry afloat has been the in-house consumption, because out-of-house consumption for the last couple of quarters has been slightly on the weaker side. How do you look at the out-of-house consumption? Is it picking up now as the unlock begins?
See, the first quarter was bad. First quarter was bad in terms of both out-of-home consumption was surely very down, around 35–40% down. This has reduced in the second quarter by around 15 to 20% lower. So this first half of the year, we were around 5% down over last year. So overall, if you see, the unlocking has started opening up, and out-of-home consumption has increased. Mainly that is the delivery at home that has picked up. We are seeing a little bit of demand from IPL side also, that home deliveries have started, so we can get some orders of rice, basmati rice particularly, and your edible oil. Going forward, we are seeing a lot of changes happening, and with the restaurant and bars now opening up, albeit at 50% capacity, I hope the consumption out of home will start slowly increasing.
Mr. Malik, as you said, the in-house consumption did see an increase, even as the out-of-house has seen very sharp declines, as you just mentioned, in the first and the second quarter. Was the in-house consumption good enough to fill the gap that the out-of-house created? How are you looking at those numbers as well?
Not fully. First quarter, the in-home consumption was around 15 to 20% high, and out-of-home consumption was around 40% down. Second quarter, in-home consumption was around 10% up, and out-of-home consumption was around 20% down. Going forward, we feel around 5 to 7% increase in in-home consumption, and out-of-home consumption coming down, at least managing last year's level, or maybe 10% lower than last year. But every quarter on quarter, we are finding consumption at home is slowly reducing now.
So out-of-house consumption is clearly coming back, and in-house is getting even better. Expected, as Mr. Malik said, that next quarter, or the current quarter rather, could also see 5 to 7% on an increase in an in-house consumption there. Avinash, what is your sense when it comes to sugar? Because the month of March and April were quite bleak for every food commodity. But then month on month, we have seen it pick up. People have been cooking more and more in-house, and sugar clearly has been the choice of consumption here. What is your sense? What was the consumption levels like in the last year, and this year? Are we anywhere near the targets?
Yes. Hi, Manisha. Basically, we don't have the figures of actual consumption. What we track is the sugar sales from our sugar mills, and that gives an approximate idea what exactly is happening in the market. Yes, in the beginning, in the end of March and in April, we did see a fall in consumption and demand and sales also. But thereafter, it picked up very well. And if I compare the current year's sugar sales from the sugar mills as compared to last year, we are almost there, or we might be a lakh or a couple of lakh tons more than last year. But if I compare ourselves with what we were expecting to sell this season, we will be about 3 to 5 lakh tons less than what we were expecting. So there has been, I would say, a lower kind of consumption as compared to what was expected, the normal growth. But as compared to last year, it'd be slightly more.
But you've just about, as you said, managed to keep on the numbers that we saw in the previous year or the pre-COVID levels, and that's clearly a plus for the sector there. Ajay, I want to come to you now, and we've discussed edible oil and rice and sugar as well. What is the sense with wheat? Because we've been doing this story over and over in the last many months now on how the sales of biscuits have been on the higher side. Phenomenal, actually, when you look at those numbers there. And this clearly has been an in-house consumption area from the very beginning. So we have seen a surge there. But what is the scenario right now? How would you look at the past couple of quarters, and where do we stand today?
So I think as far as wheat and grains is concerned, we actually peaked out in April. There was a lot of fear. People were stocking up, and across the chain there were shortages felt. So post April, we have seen that house consumption has been fairly stable, and out of home consumption for processed foods, things like maida and suji and other things will only improve when there is no fear amongst people to even go to these restaurants or eateries or thing. I think the coming quarter is going to be a deciding game for us, because if people do venture out to have that little extra snack and there's a larger floating population, then definitely we will see at least a 20 to 30% rise in consumption of food products.
Well, clearly, we've seen the biscuits demand jump up, not so much for bread because that's an out-of-house consumption area in any case. But Ajay, would you say that this quarter could see a jump up now? Because as all of you have said that as the markets open slowly, people have been asking for home delivery in any case. Do you see that demand surge up in this quarter now? And what targets, what numbers are we looking at here? Is it going to be wheat, atta in its basic form, or is it going to be biscuits, breads, food grains, refined products? What are we really looking at?
So what we are actually looking at is, until that neighborhood thelawala starts operating in full swing, until then we don't feel that the true demand will be percolated and be shown in the system. Right now, this is like a very small segment of takeaways, and that's a fairly urban phenomena. But across the country, there are B and C towns and other places where food access is still there, but people aren't going there to restaurants or maybe smaller eateries or things. And it's also, there are lots of consumption points of joint messing when the population comes into cities. There are these big kitchens and canteens and things like that that would start operating. So I guess once, the entire chain of the horeca and the street vendor, and there's a floating population and people are moving about, and then they feel the desire to have the tea and the sandwich and the bhel puri. Until then, we really won't see a big surge in demand, is my view.
All right. Mr. Malik, what are you looking at in this quarter now? Because this is a time when we will see the festivities begin as well. What is your initial feedback and preparation that you've been doing for this quarter now? I know the weddings are going to be smaller. I know the festivities are going to be smaller as well. But do you see the demand pick up at least quarter on quarter?
See, we are little bullish this quarter because October, November, December are generally a large business months. Diwali, Dussehra together, followed by 15th November onwards marriage. And then you have the New Year and all that. So all put together, there has to be some improvement in the demand. We are gearing up for that. And I hope at least 15% higher volume business over Q2, that is the July, August, September. And I am confident because there are 2-3 festivals that will club, and then the marriage season kicks off. Marriage may not be so big event, but still at least there will be demand coming in, and the rural marriages will start happening this time.
Mr. Malik, I also want to dwell into another area, and that has been the farm bills and the MSP hikes. And while we have seen protests from the farmers on the road and the states as well, opposition, of course, what does it do for your life, for a company like yours, and how does that impact in the very near term?
See, I think from the farmer's point of view, if you look at them, they can produce anything that they want, but they cannot sell anywhere that they want. And now that is unfair, if you ask me. Farmer should be free to sell anything, anywhere, to anybody. Wherever he gets more money, he should sell. And why should we stop him from selling? Corporates always wanted options to buy from APMC as well as directly at the farm gate or at our own factory. We are not saying we are against APMC, and it's not that we will not have any buying from APMC. APMC market yards will continue to be the best price discovery mechanism, and we will continue to buy. But we now have an option to buy outside the APMC and reduce our cost. Whatever cost competitiveness we get, these are all part of the business, and most of it will be passed on to the consumers in some form or the other. So I think all corporates are more eager to see how this happens. APMC, see in Punjab, Haryana, paddy has started coming. They were having 4.5% tax, 4.25 in Punjab, and in 4% in Haryana. They have reduced it to 1% in Haryana and 2% in. So now there is a lot of means at least there is fair play, and we can buy from Haryana mandis, and we don't mind paying 1%. So I am open to both the thing, but options always are good for both the buyer and the seller.
Oh, well, yes. And you are yet another voice, Mr. Malik, who has been positive on the overall farm bill here. Avinash, there's been a lot happening on the ground. There have been 3 bills that have been cleared. How do you look at life, if I may say, post-COVID, post these farm bills, this quarter, the next year? What are the plans on ground now when it comes to sugar as an industry?
Yes, yes, Manisha. Let me first clarify that the farm bills or all the 3 farm bills do not directly impact sugarcane or sugar, because sugarcane in our case gets delivered directly at our factory gate by the farmers, or we pick it up from the farm directly. So there is no middleman, or there is no arthia, as they say, and the sugarcane doesn't reach the mandi, so therefore it doesn't affect us. Number 2 is Essential Commodity Act. Sugarcane and sugar continue to be in sugarcane in the Essential Commodities Act. So there also there is no difference as per the new farm bill or all the changes which have happened. The state governments and the central government do reserve cane areas for each sugar mill, and we have to buy all the sugarcane which is grown in that area. The price is fixed by the government. So the life, I don't think, will change for the sugarcane farmers or the sugar industry because of these changes. Now, as far as the next year for the sugar and sugar industry, I see it very positive because of the ethanol story.
Right.
We are not only able to dispose of the surplus sugar that we are making by way of exports into the international market. This year, we would have done almost 5.8 million tons of sugar exports, a record ever. Despite the COVID problem, we have done much more than any of the past years. Next year, we will export again similar quantities or even more. But the bigger story is ethanol. Ethanol, we have now started producing by diverting sugarcane juice. I know one of the companies produced almost about 64% sugar and 36% ethanol. So that is the long-term story that we are looking at. Divert the surplus sugar into ethanol, help the country blend it with petrol, reduce that petrol consumption, improve the air quality, reduce pollution, reduce the import bill. So therefore, next 12 months, I see a very good story for the sugar industry from the point of view of ethanol and sugar.
Absolutely. The greener fuels and the climate change is going to be a big subject as well in the coming year once we've done with what the COVID has to give us there. But Ajay, what is your sense on the demand now? How are you looking at the wheat prices going forward? And this whole scenario change where we've seen the online buying, the e-commerce do quite well. Does that change the face of human consumption also?
No, so definitely e-commerce has been tested very well in the past 6 months, and lots of people who have simple smartphone have really got on to it. And so I guess definitely that segment is what is going to grow in future. So what we have also seen is like home consumption of atta in the past 2 quarters. Companies like Amazon and Flipkart and big baskets who are delivering home have seen a big offtake than the actual stores which were servicing the markets. So going forward, I think we will come to a point where demand will stabilize to previous levels. But I think until the fear exists, it's going to be a slow upward tick. And as rightly said, no banquets and no big banquets and catering. All these things add up to the whole amount and quantum of business. And also the fear is over as far as shortages are concerned. There is enough in the country, enough in the economy. So there is no pipeline stock which is in stocking. So that is another reason why markets are also subdued. But I guess the next 2 quarters are definitely going to be much better than what we have seen in the past 2 months or 2 quarters.
Oh, absolutely. Mr. Malik, one final question to you as well. And while we are looking at the price views on various commodities, we've seen the edible oil prices run up quite strong, 40% in last 5 months. Now, of course, it seems to be stabilizing. But even as the consumption is increasing and you are optimistic, positive for this quarter, what's your sense on the prices, though?
See, the edible oil prices have shot up in the last 6 months. And you have seen in palm and soya, we have seen around 15% hike. And in sunflower and mustard, we have seen around 35-40% hike. Now, these are hike mainly because one, supply side constraint. Second, not able to judge or predict the crop in Russia, Ukraine of sunflower. And mustard was in demand all through because other prices of other oil went up. So mustard went up and mustard demand was much higher. I think going forward, the prices have started coming down and have started trying to get into that normalcy thing. And I feel prices are likely to be stable October onwards because we will have Indian harvest of soybean crops. So at least that pressure will be there. And going forward from January, February, March, the new mustard arrival will come. So next half, that is October to March, we personally don't see great bull run in edible oils. Basmati rice and rice also will remain low because good production. Wheat also is going to be good. So I think overall agriculture prices will remain stable.
Oh, that is good to know. And those are the three sectors within the food as a segment where we have seen normalcy near returning. The demand is hopeful on the higher side and there are new trends playing into that market as well. But with that, thank you, gentlemen, for your valuable views. On that note, we will take a very short break. But on the other side, we will be joined by Francisco Blanch, Head of Global Commodities at the Bank of America, with his views on outlook on various commodities. Welcome back and you're watching Commodity Champions. Year 2020 has been a bumper one for commodities due to unprecedented volatility and market dislocations due to the coronavirus pandemic. Gold and silver have been the biggest outperformers, giving historic gains in the past few months. Other metals like aluminum, copper, zinc also have seen healthy gains. However, crude oil prices have seen a sharp decline due to travel restrictions amid COVID lockdown. So what lies ahead for commodities in the remaining part of this year? Joining me now to answer all of our questions is Francisco Blanch, Head of Global Commodities at Bank of America, Merrill Lynch. Francisco, hi, good to have you. I want to start with gold because we have seen the prices run up because of the presidential elections. It has been COVID. The economic recovery has been uneven. What is in store for gold now for this year and the next?
The sense, I think, is that heading into the election, there's going to be a little bit of risk-off move across the board. Obviously, that's led to a sell-off in equity markets. We've also seen some US dollar appreciation on the back of that risk-off move, and naturally that has impacted gold prices over the course of the past couple of weeks. However, we still hold on to our fundamental view of gold, which is that the enormous fiscal and monetary policy stimulus that we've seen will keep gold on track to $3,000 an ounce over the course of the next 18 months. And remember that regardless of who is president, we are still going to face zero interest rates for a very long time, with the Fed likely continuing to expand its balance sheet to support the economy. And at the same time, we're going to face huge fiscal deficits in the US and around the world as a result of COVID-19.
$3,000 per ounce in next 18 months, Francisco. Would that rub off on silver as well? Do you think silver prices will also perform the gold way?
Well, so for silver, obviously one of the things to think about is, to your point, is very volatile. It's a lot more volatile than gold. So that's the first thing investors need to be aware of. Second thing is that the volatility works both ways. when gold prices, precious metals prices start to spike up, silver tends to gain steam faster than gold, but also tends to retrace faster than gold. So it's important to keep that in mind. We are still constructive on silver as well, because there's two drivers of silver. One is the precious metals markets and the connection to gold. The other driver is really much more around the industrial connectivity of silver. Silver is critical in solar panels. We think that the demand for solar panels, as we put together the energy transition towards a lower hydrocarbon economy, is going to continue to lead to more silver demand. And again, this is going to be this year, next year, and for the next 10 or 20 years. So silver has both the precious component, but also an industrial component linked to the energy transition and to a low carbon economy. So that's why we like silver. We're targeting $50 an ounce again over the next 12 months, 18 months.
All right, so good gains for gold and silver is what is expected for the rest of this year as well. But that really brings us to crude prices now, and the recovery here is expected to be the slowest amid all sectors, with the kind of restrictions that we do understand within the country and outside as well. What are the cues you're watching here and the price levels?
Crude oil faces a major problem because, remember, COVID-19 is first and foremost a mobility crisis. We are all moving a lot less than we used to. I used to travel to India once a year, sometimes even twice a year. I used to go to China 3 times a year, all around the US. Now I'm sitting at home. I've been sitting at home for 6 months. And that's likely to continue for a few more months. And I think that the same thing applies to a lot of people. Business travel has collapsed. Leisure travel has also come down. People are working from home. They're not commuting. So the reality of the matter is mobility has come down. There's a few small offsets. For example, people are avoiding public transport and they're using private transport more often. So we are seeing more use of cars and motorcycles. But the reality of the matter is we have a major mobility crisis. People are not moving around. World demand for jet fuel is down 50% year on year. And in aggregate, oil demand is still down today between 7 and 8% on a global basis year on year. So that's the problem that oil has. As a result, we have a lot of spare capacity because OPEC has cut production. And I think until we recover the mobility, maybe in 2021 or 2022, we're going to see oil prices low and range bound. We are forecasting $43 a barrel for Brent this year, $50 a barrel for Brent next year. But again, range bound prices because of all the spare capacity and limited upside to the market here.
Well, that point is well taken, and stability in crude oil prices will be a big welcome. But metals rally, and that seems to be tiring. For example, the Chinese demand seems to be slowing, and ex-China also seems to be very uneven. How are you looking at this sector?
Industrial metals markets, base metals, are much more connected to the industrial economy than energy is. Energy is a transportation fuel. Oil is transportation fuel. What we've seen is COVID-19 impacted transportation, but it's not impacting industrial activity as much. It is impacting it. So we saw a drop in metals prices in the second quarter, but we've also seen a recovery in industrial activity. And we expect, in particular, some of the metals connected to the energy transition to perform well. Which are those metals? It's copper, it's nickel, it's cobalt, and to some extent, we think aluminum probably gets a little bit of support for use around the world. So we are constructing metals. We are most constructive copper, and think that the deficits in copper heading into 2021 are going to keep growing larger and larger. So we think this is a good time to be going into industrial metals. We expect infrastructure spending, industrial activity to lift them higher.
All right, Francisco, you listed out 4 metals at least where you are bullish going forward, but would you want to give price targets as well, especially for copper and nickel?
So we think copper could rise to $7,500 a ton. So some upside here. We think that aluminum, on the other hand, maybe gets a small, modest uplift. There is a lot of aluminum in storage. For nickel, we think prices could surpass $15,000 a ton. So we are constructive on some of these base metals, but again, I'm particularly focused on the base metals connected to the new future energy technologies, in particular electricity and electric networks, charging stations. That's what's going to drive metals prices higher, infrastructure spending and industrial activity in the metal space.
All right, Francisco, we'll let you go at that. And as you mentioned that pre-pandemic, you would visit India once or twice in a year. We hope those days to come back yet again. But with that, it's a wrap up on this edition of Commodity Champions. Thank you for watching.